Hello everybody, this is Toni Turner and welcome to the market now as of about 11 a.m. Eastern on Friday, March 24th, and a busy day it is. Wall Street did open higher today, helped by a rise in technology shares and ahead of a closely watched vote on a healthcare bill. It was not clear late on Thursday evening, last evening, that Trump and the Republican leaders had enough support to pass the bill, with Trump warning lawmakers Obamacare will remain in place if they do not vote to replace it. Investors feel that a failure to pass the bill could endanger President Trump's promises of tax cuts and stimulus. On this past Tuesday, Wall Street recorded its worst one-day loss since before the U.S. presidential due to these concerns. The Dow and the S&P 500 are now on track to post their first monthly decline since October. 9 of the 11 major S&P sectors, however, are higher so far today, with the technology sector leading the advancers. And now let's go on to some charts that could give us some insight into the week to come. First of all, as we always do, we're going to look at our daily chart of the S&P 500 spider, symbol SPY. When I captured this chart this morning, the SPY, which of course is the exchange-traded fund that follows the S&P 500 benchmark index, was trading at $234.59. Now we know that the SPY made a new all-time closing high on March 1st at $240.32, right around 2,400 on the S&P 500 index itself. Now, the SPY, of course, has kind of moved down here ever since. This was this past Tuesday we were talking about a minute ago. It did fall down there to a low and then down to Wednesday of 233. And what it did was it's now below this red line, the 20-day simple moving average on my chart. Now the SPY has come down to almost, and this Wednesday, almost touching but not quite, the simple 50-day moving average, and it hit a low this Wednesday of about 233, so we're cutting it pretty close here. The 50-day moving average is a very watched moving average. It's considered to be an intermediate term moving average, meaning that it follows intermediate term trends, uptrends or downtrends. And right now, of course, we are in an uptrend. So what that means is as long as the SPY or the S&P 500 stays above this rising to 50-day moving average, and rising is a good thing. It means that price is continuing on average to move higher. As long as the S&P 500 stays above this line, then we're pretty much in a good position. Now the green line, the 50-day moving line here, is coming in at about $233 or about $23.30 on the S&P 500 index. So we have support here after this line at this 50-day line at 233. We also have more support here at $230 on the SPY that would line up with this little pop in January. And then, of course, we have more potential price support down here at just above 225 or at 225, which is the blue line, horizontal line that I've drawn here. Now, I have put a red highlighter mark on this chart right below 225 because since there is quite a bit of support here, should the SPY actually, and of course it wouldn't happen in a day or two, but should it get worn out here for the rest of March and on into April, should it get tired and move below the 50-day moving average, move through that price support at 230 and down below, hopefully not, but down below this 225, that would mean that people who supported this index earlier this year are no longer willing to do so. And of course, that would very definitely be quite a pullback in the market. Now, the markets of industrialized nations move in cycles. They go up and down. They do not go straight up forever. And we've had an incredible bull market since the year since 2009, when the market turned around from its really bad downtrend and started higher. Nothing goes up forever, and we have to realize that actually it's a healthy thing. It's like a rest. It's like the major indexes or the stocks in our stock universe need to rest sometimes before they can start higher. So if we do get a pullback here or even a slight correction, this would be normal, natural, and it will afford us some wonderful new opportunities. In the meantime, I'm maintaining my cautious approach right now to the market with any new positions. I'm going in with much smaller share size and very firm stops, very firm stops. We've got some great profits here, and I'm not willing to give them back. Okay, our next chart here is a chart that we've been watching recently. A chart of the iShares Russell 2000 Exchange Traded Fund, symbol IWM. As you know, if you've watched our lesson before, the Russell 2000 is the small cap index, and it can many times act as a leading indicator for the broader markets. So we do keep an eye on the IWM. The ETF is an asset that everybody can put on their screens. Now the IWM, the iShares Russell 2000, made an all-time closing high on March 1st at $140.36. Since then, it has lagged. It has not been as happy as the SPY, certainly not as happy as the NASDAQ. The Russell 2000 is getting weak here. It was a real powerhouse in the last few years, an incredible powerhouse, but now it looks like at any rate right now it is getting a little worn out, and it makes perfect sense. You can see this loss that it took on Tuesday, also falling below its 20-day, the red line, and the 50-day moving average, and now moving down close to prior price support at about 133. And I've told you all for a while now, we are watching this potential price support here at 133. I've drawn the horizontal line here, and oh boy, IWM came right down to it. It even went a little below 133, down to 132 and change on Wednesday. I was holding my breath for sure, and then popped up again, fortunately, for the last couple of days. Now the IWM has some work to do here. There's quite a bit of overhead resistance. There's quite a bit of overhead supply. Certainly the folks who bought the IWM when it was up near its highs in December and moved up to its highs in March of this year, folks who bought up here are now worried, we could even say scared, and every time the IWM tries to pop higher here, it's getting barraged by all the bears, by all the folks who bought and are scared and said, no way, if this thing starts a little higher, I'm getting rid of it. Of course, there are also people who bought earlier on, perhaps in this big Trump move up here in November, or even in the past years, that are now saying, you know what, I'm not giving my profits back on this one. So there's a lot of overhead supply here for the IWM. It's going to have to be one tough dude to get back up here, absorb that supply, move back above the 50-day moving average at about 136 and change. If it can do that, it is indeed very, very resilient, and that will be a plus for the market. If the IWM cannot move back up above its 50-day moving average, if it instead kind of rolls over and says, I've got to rest here, and moves below 133, then I believe it could be kind of a negative indicator for the broader market. So keep an eye next week on this 133 line, or alternatively see if the IWM can move back above the 50-day moving average and close above it and stay above it, at which place I will, or at which point I will exhale. Until then, I hold my breath. Okay, the iShares Multimedia ETF. I don't believe we've ever looked at this IGN before. The IGN ETF is actually the iShares North American Tech Multimedia Networking ETF. That's its full title, symbol IGN. And I noticed it today. To be frank, there were not a lot of buying opportunities today that were orderly, that made a lot of sense to me. And the IGN was one that did. But again, I suggest you go into any new positions, especially long ones, in this coming week with small share size, again, and firm stops. And we've got a low risk play here because the 50-day moving average is right beneath price. So if it falls down just a little bit, I certainly will be out of the trade. The top components of the IGM are Motorola Solutions, Harris Corporation, Juniper, Cisco, Palo Alto Networks. Now this year, and as you can see, the IGN likes the 50-day moving average. It likes this green line, and if you were to go back further on this chart to make it an earlier chart, and perhaps look at another 6 months behind this September 2016 line here, you would see that the IGN just flat likes the 50-day moving average. It'll come down to it, maybe close a little below it, but then it tends to pop back up and move higher again. So if it can keep up this record, it might be something to consider. It made a low this year at $42.99 in January, below the 50-day moving average, then popped up to a new all-time closing high of $47.81 in the middle of February, and you can see the heightened volume here. Yesterday, I noticed, if you go to the hard right edge of this chart, yesterday we had a very nice volume spike. This is not a day trading instrument. This does not have high volume, but it still has a relatively orderly pattern, which I like. So I saw a volume spike yesterday. I noted that the IGN was starting up today, and today, as I captured this chart, it's trading at $45.64. It popped up today back over its 20-day moving average. It is, as I said, just barely above its rising 50-day moving average. The 200-day moving average is nicely below and rising, which is a good sign. Now, the RSI here I actually like, because the 14-day RSI was definitely overbought when it made those highs in February, as it would be. Then the RSI fell dramatically, as it would with price, and then started higher again, making a higher low here, which I like, which is bullish, and the IGN did too. But now it's just at the 50 line, the RSI is, which is the median line for the RSI, and hooked up. Again, we have that low volume down here, or the volume spike yesterday that I like. The MACD here is totally neutral. So what I'm going to do here is I'm going to watch the IGN. We want to get through this healthcare vote today. I'd really like the weekend the market to have the weekend to decide where it wants to go next. I don't think the IGN is going to go anywhere in particular today that would make a difference. So coming Monday, I'm going to keep an eye on this IGN, and if it starts moving up and it gets up to 46 and starts moving up in that direction, again staying above the 50-day moving average, I will be interested in small share size in the IGN. Now this was an all-time high up here, so of course if IGN makes it back up to 48, that would be very nice, and then there's blue sky up ahead. Otherwise, if it falls below the 50-day moving average, I am out and no longer interested. Okay, now let's go on to next week's economic reports. But first, please join us on Monday, March 27th, this coming Monday, for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. And I also give you the entries, the protective stops, and the profit targets. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. Plus, we have a really good time, so please join us. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information, go to tonysmarketclub.com. Now, for Economic reports this coming week, nothing much going on Monday. On Tuesday, we have consumer confidence. On Wednesday, we have pending home sales and crude inventories. On Thursday, we have the GDP third estimate. That will be watched, the jobless claims, and of course our usual natural gas inventories. On Friday, we have PCE prices, Chicago Purchasing Managers Index, and the Michigan Sentiment. Again, join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.